Charles, what themes in Monk's portfolio are you most excited about at the moment?
Well, apart from the Asian savings companies, which I mentioned earlier, and in addition to Pru, we also own AIA and Ping An. I think there's three broad themes. So the first is some of the more focused internet platforms and services. So the first round of the internet applications were consumer focused. They were social networks, advertising based, e-commerce companies. But the current wave is more subscription-based services, taking costs and complexity out of the system. They're often built specifically for the cloud and to best generate and use data. A lot of these are certainly newer companies showing very strong growth rates, and names would include Teladoc and Ping An Good Doctor, both of which are telemedicine companies, Farfetch, which is a luxury goods retail e-commerce, Chegg in education, Adyen in payments, and a smattering of cloud-first enterprise software companies, including Cloudflare, Datadog, and Snowflake. They all have very exotic names. So that's the first category. The second theme is what we call the eye of the storm. And there are some recovery stocks that we have been buying through the summer. Industries which are feeling very severe stress at the moment, but where we do expect more normal demand to return. And in particular, two leisure travel companies, Bookings and Ryanair, who should both be share gainers because of financial and operational strengths, combined actually with the severe weakness of many of their competitors. So in fact, Ryanair is in the process of adding 200 new airplanes to its fleet at the same time as its major competitors are permanently cutting their capacity by between 15 and 20%. And then there's CBRE in real estate, because we don't expect offices to become entirely redundant. And even Lyft, which is the more focused US competitor to Uber in ride sharing, who have some very interesting longer term growth options. So eye of the storm stocks is a recovery theme. And then lastly, and probably controversially, I'd cite an enthusiasm for the very unfashionable mining majors. So we have recently bought into Rio Tinto and also added to BHP, anticipating a likely tighter markets in metals after 8 years of very muted capital investment across the sector, because cash flows were used firstly to pay off very large debts, and since then they've been dedicated to dividends, and there's been minimal levels of spending on production, which is beginning to lead to supply shortages already, which is amazing when you think about it, even in a pandemic. Now, you analysts here are unanimous in predicting lower prices, lower metals prices, and lower profits, but we're not so sure, and we expect a useful boost to come to demand from plans to build back better. And what is clear to us is that our hypothesis of strong pricing is most definitely not reflected in current valuations. So these companies bring a very different type of risk and opportunity to our portfolios. So we've got three categories: data-driven growth stories, sure bet recovery plays, and then a slightly off-piste exposure to a very unfashionable mining sector.